So what are the qualities of one of these great life insurance retirement programs, right, of these IULs? Well, first of all, you eliminate all those IRS penalties, okay? If you design it properly and access the money the right way, you can avoid those penalties before 59.5, and you can avoid those penalties after 72. Those required minimum distributions, those RMDs. Why? Because the IULs, the way they're written in the tax code, do not abide by these rules. These rules are for 401ks, 403bs, IRAs, not stuff that we offer within life insurance programs, okay? You're also not going to get a 1099, and by that I mean 1099 is from the stuff you get from the bank, right? You put your money in a savings account, and the bank says you gained 0.5% interest over the past year. You now owe taxes on the 15 cents that you gained in your savings account this year, and they send you a statement for 1 cent of taxes to be paid. Right? You don't have to worry about that when it comes to the IULs because there's no 1099s when it comes to accessing the tax-free funds for these programs. The distributions that come out from these IULs are not reportable income. Now, what's reportable income? Whenever you retire, you will hopefully receive money from Social Security. When you receive money from Social Security, it could potentially be taxed depending how much income you receive from your other investments, 401ks, IRAs, 403bs. Any of those programs impact the taxation when it comes to Social Security. Well, what doesn't impact that is IUL money. If you're able to get money from the IUL via the tax-free loans we're going to talk about here in a minute, that is not reportable income. It does not impact the taxation of Social Security. That's powerful. That's powerful. With the IULs, there's no contribution limits. Okay? That means you can put as much money as you want into these IULs as long as you qualify for it. And qualify means the amount of how much life insurance you're able to qualify for based on your income and go from there. But you can put as much money as you can without have to worry about the IRS telling you, oh, you're maxed out at $6,000 for your IRA. You're maxed out at $16,500 for your 401k, whatever that number may be. So there's no contribution limits. There's no income limits. And by income limits, I mean, if you want to try to do a Roth IRA, or especially a Roth IRA is the main one, if you make too much money, you cannot contribute to the Roth IRA. When it comes to IUL, it doesn't matter how much money you make, there's a program for you. And then legislative risk. What does that mean? That means that the government can change the rules of the game. And they can always do that. For example, just recently, they changed the RMD age from 70.5 to 72. So if you had an IRA and you're hoping to get it at 70.5, you have to wait till 72 to avoid those RMDs. Now, granted, are the IULs potentially at risk? Only the ones that in our experience, what we've seen is the ones that are at risk are any program starting from the point the rules change, moving forward, it's not retroactive. So if you have an IUL today, you'll follow the rules that are active today. If the rules change tomorrow, then you play by those rules. So the point of this is if you have a client looking to lock in an IUL, do it now before the rules start changing. What those look like in the future, we don't know. But the point is we're selling life insurance today, not tomorrow. So let's focus on what's available today and use that to our advantage. So these are the 6 things that we feel that make an IUL important. As you can see here, none of this talks about the illustration rates. That's important. But these are the benefits you got to focus on when it comes to the IUL and the power of what it can offer to your clients. Other qualities you want to look for in IUL are these 4. That they're safe and productive, that they have low fees, they're tax-free and cost-free distributions, and they have a cost-free long-term care type rider. All right, I'm going to break these down and show you why this is important. These might be some good points to bring up when you're having conversations with your clients on IULs. First of all, safe and productive. What I want to do is I want to compare the rate of return of the stock market, which is S&P 500, versus the IULs at the time. Now, whenever you go into your IUL illustrations, when you go to the screen or the page that shows you the last 20 years, and you look at the indexing strategies, you're going to notice that they only use the most current caps. So right now, caps are 9.75, 9.5, and they go retroactive from 2020 all the way back to 2000. But if we really looked at the numbers and we dug deep and we looked at what were the cap rates at the time, it tells a different story. So I want to show what that looks like today in this example here. Let's compare 2008, 2009, and 2010, some of the worst years the market's seen over a 3-year period. Over that time frame in 2008, the stock market went down 38.49% in the S&P 500. So that means if you start out with $100,000 before that, and you lost 38%, you'd have only $61,000 left in your account if you're 100% invested in the market. If you're in the IUL, since your floor is zero, you have $100,000 today, you still have $100,000 tomorrow because you lost nothing. You're already $38,000 ahead by getting a zero. That's why I talk about that zero is a hero when it comes to the IUL, because of this situation here. But what happens when the market bounces back up again? The markets went up 23% the next year. Usually happens. There's a big down year, there's a good up year the year after that. So now you're building 23% from your $61,000 that you were before if you're in the stock market. So now you have $75,000. You don't even back to your initial $100,000 investment you had 2 years before that. With the IUL, at that point in time, the cap was 14%. So you get 14% of that 23, you're at $114,000 versus $75,000 if you're in the stock market. Let's go one more year, 2010. Those markets went up at that point 12.78. If you're in the stock market, you've gotten 12.78 off of the 75,000. You're now at $85,000 is where your account would sit at from your initial $100,000. You're still 15,000 below where you started 3 years ago. With the IUL at that time, the caps were at 13.5. So the 12.7 falls under 13. You get 12.7. Now your account sits at $128,000 in your IUL. Now you tell me, Mr. and Mrs. Client, would you rather be after 2008, 3 years from now, at $128,000 in your account or $85,000? It's a no-brainer, guys. $128,000. That's a 50% difference. 50% difference from being in the stock market compared to the IUL. 128,000 minus 85,000. It's a big difference when it comes to planning for retirement. But now let's look at the most recent years, because the stock market has done really well over the last 3 years compared 18, 19, and 2020. So in 2018, the markets went down a little bit, 6.24. You look at the S&P, so we lost a little bit. Luckily, the S&P wasn't down too bad, and with our IUL, we stayed at 100,000. But you'll notice here, over the last 3 years, the caps have been a little bit different. In 2018, the caps were at 12. In 2019, the caps were at 11. And then most recently, 2020, the caps were at 9.75. So we're going to see how that impacts the returns here. Because in 2019, the markets did fantastic. 28.8%. So you're in the stock market, you did great that year. So S&P, your account would go from 93,120. That's a great year of returns. With the IUL, you're capped at 11 versus 28. It's okay, you have 111,000. You're still behind the market, but at least you didn't lose anything the year before that. As of right now in 2020, the markets are about 4.5% as of today. Okay, we still have a couple months to go, so we'll see how that pans out. As of right now, the markets have gained everything that they lost and then some at 4.5% gain. So that means if you're in the stock market, you'd have been 126,000. With the IUL, you only get the 4.5, you're at 115. So technically, you're still in the hole if you're in the IUL compared to the stock market this year. But remember, guys, the IUL is a long-term play. This is not a short-term game. It's a long-term game. We're playing for the fourth quarter. We're not playing the 5 minutes into the half. Okay? We're playing this till we're 50, 60, 70 years old. So that's something you have to really try to focus your clients on. It's not so much what happened this year. Actually, what's going to happen in the next 20, 30 years. Right? I'm about to be 39 years old. I have to think what's going to happen when I'm 69. 30 years from now. What's the market look like from 1990 until 2020? Is it going to be the same for 2020 and 2050? I don't know. Will the taxes be the same now when they're in the future? Shoot, 30 years from now, we'll have had, what? Potentially 4 or 5 more presidents being elected? No matter if they're Republican or Democrat, who cares? What matters is who's president when you retire. 20, 30 years from now. That's what's going to impact your retirement. So you got to think about that when you think of retirement planning in the future and how we use the IULs. And the beauty of it is, it doesn't matter what taxes are going to look like in the future because we have tax redistributions coming from these programs. That's what's the beautiful thing about these IULs. So let's look at the 20-year comparison. Let's take a look and see what the markets have done in the last 20 years. The last 20 years have had a lot of rocky roads behind us. We've had the dot-com crash. We've had the financial crisis. We've had some turbulent times. We also had some great times. Okay? So if we look at the S&P 500 compared to the IUL, if we look at that and say we had $1 million back in $2000, year 2000, $1 million 2000, that money would have doubled in 20 years from 1 million down right at the bottom of the column. You see $2.198 million. Remember, it doubled. That's a rate of return of 120%. If you'd been the IUL, had $1 million in your IUL, and would have kept the cap at 9.75, being conservative. I didn't even go back and change the caps. This would be conservative, as Eric mentioned. Play it safe. I put a cap at 9.75. So at $1 million, where would we end up in 20 years with the IUL? Almost 3 times that amount at $2.9 million. That's a 194% return. In the IUL over the last 20 years, you've been ahead of the market by 74% more than the market over the last 20 years. It's a long man's game or woman's game. It's a long game here. We're talking 20, 30, 40 years. You're talking to millennials now. They're in their 20s. What's it going to look like in the future? Not from a returns perspective, but also from a taxation perspective. That's the power of having these IULs. Now let's talk about fees. Okay, people sometimes talk about, oh, life insurance is so expensive, right? It costs so much to insure somebody. Well, yeah, any business can charge a fee. They got to make money. National Life has to be in business. American National has to stay in business, right? They have to pay back dividends, they have to pay back potential stockholders depending on if the company's, in the stock market or not. So there's got to be fees. But the question is, how do you look at the fees? Okay, there are fees that are percentage, and there are fees that are flat fees. Percentage fees get bigger over time because your account values grow over time. The percentage might stay the same, but the value grows, so the fees get bigger. There's a flat fee involved. The fee stays the same no matter the value. I'm going to show you what that means in here in a minute. On average, a Roth IRA is going to have a fee about 1.5% per year. Okay? So if your Roth IRA account has $10,000, 1.5% of $10,000 is only $150. That's a pretty cheap fee to pay today. IUL, compare that. Let's assume the cost of insurance is the expense ratio is $10,000 of the cash value in the policy. You're going to pay $1,500 in cost of insurance in your first year of your IUL. So right now, an IUL is more expensive than a Roth IRA, right? $1,500 versus $150. What happens as that value grows over time? Let's look at that. So for example, we have the Roth IRA. Right now we said $10,000 account value, 1.5%. Your fee is $150. Let's just say that value over time grows to $100,000. They still charge 1.5. It's low. 1.5% is not bad. 1.5% of $100,000 now is $1,500. Now you're kind of matching what you're paying on the IUL. Let's just say that value grows, in 20, 30 years up to $1 million. That's the goal. I want $1 million in my investment accounts, in my IRA, Roth IRA, whatever it ends up being. 1.5% of $1 million now is $15,000 a year in fees you're paying. How's that? Versus in IUL, the fees stay relatively flat. It's not a percentage, it's a flat charge. Let's assume it stays around $1,500. It may go up, may go down depending on what's going on, but you can look at that in the illustration. Let's just keep it for simple purposes. Your fee is about $1,500 every year. Right now it's costing about 15%. Yes, it's expensive today. But as that value grows, now that cash value is $100,000, that same $1,500 now is 1.5. That's kind of the threshold, is $100,000. Once we start seeing that, we're going to see that the IUL is going to be significantly cheaper to have in the future than it will be having a Roth IRA account. Assume that cash value is at $1 million. Your cost of insurance stays about the same. Now that same $1,500 off of the $1 million of cash value now is about 0.15%. Way lower than the $15,000 you're paying using your Roth IRA account. So over time, the IUL's costs will be cheaper. Again, it's not a short-term play, it's a long-term play. You gotta think about the future, 20, 30 years, when it really matters. It's not how much you make, it's how much you keep. And right now, we're keeping a lot more with an IUL than we are with an IRA or stock account, based on the last two scenarios we've seen. You've gained almost 3 times the amount. $3 million versus the 2. And now we're looking at fees being significantly cheaper when it really matters at the end of the IUL, when the cash values are where you want them to be. That summarizes our second point, low fees. So our IUL is safe and productive, and it has low fees. Next thing is the tax-free and cost-free loan features. I have another annotation request. Can we try to clear it again? So there are ways to take tax-free and cost-free loans. The idea with the IUL is it has to be a loan. That's the only way the money comes out tax-free. You don't get taxed on loans. Right? You go borrow money from a bank, they're not going to tax you on the loan. They'll charge an interest rate on that loan, but they're going to charge you taxes on that loan. Okay? However, if you take a withdrawal from your IUL, then that becomes income. Once it becomes income, then that becomes taxable. So we never advise anyone to take out withdrawals from the policies to avoid the taxation. You want to take out loans from the IULs. And the beautiful part about it is you don't have to pay them back. Whenever the client passes away, all those loans are paid back via the cash value and death benefit, and whatever's left over, the family gets to keep. How beautiful is that? Not only that, but there are ways in that you can design the distributions or the loans from the policies to be cost-free, and that the interest is charged on the loan be the same as the interest being credited on your account. So Eric mentioned earlier that right now they're forcing, with the new regulations, AG 49, the loans to only be 0.5% less than the actual illustrated rates. But we know that not to be true when it actually comes to what the loans are being offered. But regardless, let's assume that the IUL company is charging you 4% to take out a loan, but your account made 7%. That means you're positive 3. There's a way to take out loans from these policies to be tax-free and cost-free. And that's the beauty of having IULs. And finally, long-term care. Now, I want to make a disclaimer here. Living benefits in the IUL companies that we work with are not true long-term care riders. There are policies out there that offer them as riders, but the ones that we're talking about today, we've represented the last couple of days and today, are not long-term care riders, but they help provide living benefits through a terminal illness, chronic illness, and critical illness riders. So just be mindful when you're presenting this to your clients, you do not use the word, it's a long-term care rider. It is a living benefit with terminal, chronic, and critical illness. And let's walk you through what those mean. Okay? Because to be honest, sometimes it's better to die than to pay for long-term care because it can be super expensive. Super expensive. You'll blow your clients' minds when you go show them what those numbers look like. Or if they've experienced it themselves, had a family member go through long-term care, it is not cheap. You're looking on average, depending on where you are in the United States, on average between $7,000 to $9,000 a month to pay for long-term care facility for a loved one. That's potentially $100,000 a year. And that's in today's dollars, guys. today's dollars. Imagine 10, 20, 30 years from now, what's that cost going to look like? And there's a 70% chance that at least one spouse will eventually need some type of long-term care. That's a lot. So how do you protect yourself against that? Well, you can self-insure, which means save your own money, and then deplete all your accounts to pay for that. Because that's just to pay for long-term care. What about your living? What about your bills? You can rely on family members, and that's what happens most of the time. Hey, mom, dad, come live with me. We'll take care of you. We'll take on that responsibility / burden. Do you really want that for you, your family, or for that person? I'm sure that person doesn't feel good about you having to take care of them. Last thing they want is their son or daughter to bathe them when they're 90 years old. But it gets done a lot by family members. You can have a long-term care policy, which again, you can get. Very few companies offer them now, though. They're hard to find, they're hard to get qualified for and insured for, and you're going to pay a lot of money for them. But they're out there. Or you can use some of these IUL programs and use the benefits that are offered through the terminal illness, the chronic illness, or the critical illness programs to protect yourself, protect your family members, protect your family. So that's the beauty of having these types of programs, where I kind of went over here. The long-term care riders, when you get them, or even long-term care programs in particular, they're expensive. They're not guaranteed. The pricing can go up in the future. You have to qualify for them, and it's use it or lose it proposition. So if they don't go to long-term care for some reason, then you just, be careful what word I use here, throw away your money. Versus if you have that money in the IUL, use one of the living benefits tied to it. If it doesn't happen to have a long-term care issue, you still have the tax-free retirement income. If you don't use that, you have a tax-free death benefit. So win-win-win situation by having these IULs as part of your retirement portfolio. So as we know, our two best carriers that we have the best living benefits in the industry. American National with their critical illness, terminal illness, and chronic illness, and National Life's living benefits. That's the beauty of having these IULs as part of your portfolio. They're safe and productive. They have low fees. They protect from living benefits perspective, and they have the tax-free distribution. These are the benefits you're going to have to sell on in the future. Because showing the illustration and showing the potential growth, yeah, it's there, but the illustration can be limited. What other things does it provide? It provides peace of mind, y'all. Peace of mind. That's all insurance is anyway. It's peace of mind in case something happens. Right? You buy a car insurance in case you get in an accident. Gives you peace of mind knowing, hey, there's a stopgap there. I get home insurance in case something happens to my home. I buy cell phone insurance in case something happens to my cell phone. I buy life insurance in case something happens to my life, my family's taken care of. That's all it is, in case something happens. But there's a good chance that you may never get in a car accident. There's a good chance you may never have to make a home insurance claim. There's a good chance you may never crack your cell phone and get a new one. Well, something that's going to happen is you're going to die. Everybody dies. That's reality. So why not have life insurance to protect against that? So your wife, your husband, your kids, your grandkids, your family's taken care of. That's how you sell life insurance.